Hello everyone, how are you? I hope all of you are doing really good. So welcome to another session of financial management revision. And in this video, we are going to continue with capital structure, right? We are going to start with our next chapter, that is capital structure. Now, what this chapter is all about? Capital structure is the decision regarding the optimal mix of debt and equity in the capital structure of the firm. So this is another one of the more major important decisions to be taken by the finance manager when deciding about that whether you should be taking the funds from outside or whether you should be using your own funds in the business, right? That is what is known as capital structure. What amount of debt you should be using in the capital structure and what amount of equity, that is the own funds, should be there which you are going to invest in the business, right? So when you are deciding upon what should be the debt amount, what should be the equity amount, that is what is known as capital structure, right? Now, why are we studying capital structure? There are three things that we want to do in the capital structure, sir. There are majorly three things, that is maximize. What is the main aim of that? Is maximize shareholders wealth. Maximize what? Shareholders wealth. Now, how do you identify the shareholders wealth? Who are the shareholders, sir, who have invested money in your business? And how can you identify whether the shareholders wealth is being maximized or not, right? That is reflected by the EPS, right? So here we say that determination of optimal capital structure, if you have the various capital structures, that this much of, if you use, let's say in the plan 1 you are using only equity, in the plan 1 you are using 50% equity, 50% debt, in the plan 3 you are using 50% preferential capital and 50% debt, in the plan 4 you are using 50% equity and 50% preferential capital. So which of the plans you should be choosing depends upon the EPS, right? Depends upon the EPS, because the EPS reflects what? The EPS reflects the shareholders wealth, right? Higher the EPS, higher will be the income for the shareholders, right? So plan with the highest EPS will be selected, right? So this is how this is one aim. Another aim is that overall cost of capital, right? We studied in the cost of capital, WACC, weighted average cost of capital, or the overall cost of capital, denoted by KO. It should be minimum or maximum, sir? Obviously the cost should be minimum, right? Cost should be minimum, right? Cost should be minimum. And third is the value of the firm. Value of the firm is maximized, right? Value of the firm is maximized. Now, what is this value of the firm? If you talk about, sir, what is the value of the firm? Value of the firm means the reputation of firm in the market. Value of firm means reputation of firm in the market, right? Now, the reputation, how this reputation is reflected, sir? How this reputation of the firm in the market, how this reputation is getting reflected? That is getting reflected by the market price. That is getting reflected by the market price of what? Of companies' shares and companies' debentures, right? So these two things represent the overall health of business. Overall health of business. And this value of firm represents what is the overall health of business, what is the overall reputation of the business in the market. That is reflected by how much is the value of equity and how much is the value of debt of that particular company, right? So that is what is the major aim of capital structure, of deciding the right capital structure, right mix of debt and equity, that how much of the debt should be there and how much of the equity should be there, right? Okay, moving on. Now we say that value of the firm is dependent upon value of equity plus the value of debt. Now these are the three different things that you will be required to calculate. right? How to calculate these things? I'll give you the three formulas for this. How to calculate value of debt? It is dependent upon the interest divided by KD, that is the cost of the debt, right? How to calculate the value of equity? Value of equity will be residual earnings divided by KE. How to calculate KE and KD? All of you know what is residual earnings. This part, this is what is residual earnings in the income statement, right? Residual earnings, and the value of the firm is calculated by EBIT divided by KO, right? By KO. Now EBIT by KO represents what? The EBIT by KO represents that whether the firm is earning sufficient profits from the business to pay off its overall cost of capital, right? So this EBIT by KO represents that whether firm is earning sufficient profits from operations to pay off its overall cost of capital. Right, sir? So this is how the value of the firm will be calculated. This is how the value of equity will be calculated, and this is how the value of debt will be calculated. And these calculations will be used in the numericals, right? So you have to remember it how you calculate it, right? Value of debt, interest divided by KD, value of equity, residual earnings divided by KE, and value of firm is equal to EBIT divided by KO. And in case, let's take an example. If the value of equity is given to you, right, and what residual earnings are given to you, and you are required to calculate KE, sir, then how can you calculate it? In that case, the KE will be residual earnings divided by value of equity, right? This way it can be calculated, sir. That will be KE multiplied by 100. That will be KE, sir. Clear? So you have to remember this thing, how the value of the firm is being calculated, how the value of equity is being calculated, and how the value of debt is being calculated. Now, when we are saying the capital structure, we say there are two things in the capital structure, sir. We are talking about two things in the capital structure. One is debt, another thing is equity, right? When we are talking about capital structure, we are talking about two things. One is debt and another one is equity, right? Debt is what? Debt is outsiders' money. And equity is what? Equity is owner's money, right? Now, what is the payment to be made to the debt? Sir, interest, fixed interest rate. What is the payment to be done? That is the fixed interest rate, right? For equity, what is that? Dividend out of residual earnings. It can be anything, sir, right? For example, on the debt, you say you have to pay 10% rate of interest, but in case of equity, the dividend can be anything. Whatever the residual earnings you are left with, right? Anything can be paid to the equity shareholders. So from that perspective, we say that debt is a cheaper source of finance. It is a cheaper source of finance. Cheaper source of finance than equity. Why, sir? Why debt is a cheaper source of finance than equity? Because in case of debt, you have to pay only a fixed rate of interest, right? Whereas in case of equity, the dividend amount, dividend rate can be anything depending upon the residual earnings, right? So in that perspective, this debt is a cheaper source of finance than equity. Great, sir. But at the same time, debt is riskier than equity. Debt is riskier than equity, right? Debt is riskier than equity, sir. Why debt is riskier than equity? Because it has a fixed commitment of interest. Even if you are into losses, even if the business is not earning any profits, you will have to pay interest on the debt, right? You cannot skip that. Whereas in case of equity, if you are not earning any profits, that means there will be no residual earnings. In that case, you don't have to pay anything to the equity, right? You don't have to pay anything to the owners. But in case of the debt, you have to pay that, sir. So it is riskier than equity. And I ask you that, sir, this risk belongs to whom? That in case of losses, you will have to pay the interest on debt. Who will pay the interest on debt? Sir, the owners of the company, right? The risk is borne by whom? The risk is borne by equity shareholders, right? This risk is borne by whom? This risk is borne by the owners, and the owners are represented by the equity shareholders. So one thing that you have to remember, as you keep on increasing the debt in the capital structure, the risk will also increase, right? The risk will also increase, and with the increase in the risk, the expectations of the equity shareholders will also increase, right? So what I'm saying is, more debt, more risk, right? And high expectations of equity shareholders, and high expectations of equity shareholders, right? Why there will be high expectation? Because the risk of this debt, that in case of losses, if we are not able to pay the interest on debt, who will bear the risk? The equity shareholders are bearing the risk. So the equity shareholders say, if we are bearing the risk, we should be given more. This expectation is represented by KE, that is the cost of equity. Now the equity shareholders will say, we will want more from the residual earnings. We want more of earnings, and we want more of dividend from the residual earnings if you keep on increasing the debt, because we are the ones who are taking the risk. Clear? So these are some basic fundamentals of the capital structure that you have to remember regarding how to calculate the value of firm and all those things, and regarding this peculiar features of the debt and equity, that what the debt is doing and what the equity is doing, right? Now, one more thing that you have to remember here, sir, the relationship between the overall cost of capital, that is KO, and the value of the firm. We say that if the cost of the capital is less, the value of the firm will be high, right? So if this cost of capital goes down, your value of firm will increase. If the overall cost of capital increases, the value of the firm reduces. And if there is no change in the overall cost of capital, there will be no change in the value of the firm. Right, so this is another basic fundamental that you have to remember, sir. Clear? After that, there are certain theories in the capital structure. Let's discuss the theories one by one. How these theories have been built. These theories discuss that whether the capital structure impacts your overall cost of capital and your value of firm or not. Right? So theories of capital structure, the first one is the net income approach. The net income approach, there were certain basic assumptions related to the theories, right? So the net income approach says that KD and KE remain constant. Whatever is the capital structure you choose, what this leverage means, you are increasing the debt here. What you are doing is, this leverage shows the increased debt. Increased debt. He says, whatever you do with the capital structure, whether you increase the debt or whether you reduce the debt, the KE and KD are going to remain constant. This was the assumption of this net income approach. Now, what will happen, sir? If KE and KD remain constant and you increase the debt, what will happen? I just told you, debt is a cheaper source of finance. As you keep on increasing the debt, your overall cost of capital will come down. Your overall cost of capital will come down. Why? Because of the introduction of the more of the cheaper source of finance. Why KO will come down? Because debt is a cheaper source of finance. All those who have already studied from me, if you remember the examples, I have taken the examples of a boy going to the shop and buying the balls. right? Whether you are a regular course student or the YouTube student, at both the places I have taken the same example explaining these approaches, right? The simple logic is that if KD and KE are going to remain constant, right? That was the assumption of the net income approach. Then what will happen to the KO? The KO will fall down, obviously, because of the introduction. As you keep on increasing the debt, what you are doing is you are increasing your debt, sir. In this position, the leverage, debt equity ratio, the leverage means you are increasing your debt. As you keep on increasing your debt, you are including a cheaper source of finance, and as you are increasing the cheaper source of finance, your KO will fall down, right? So this is KD and KE remain constant at all the levels of the leverage. KO falls with the increase in the leverage. Optimal capital structure is the one having the maximum possible leverage, right? So what type of questions can be there? Already discussed in the module series, sir. You will be given KE, you will be given KD, you will be required to calculate the value of equity, add value of debt, you can calculate the value of the firm, and then the KO from there, right? So the questions are already discussed there, sir. So next is net operating income approach. Now, what is this net operating income approach saying? He says the KD remains constant, right? The KD remains constant. Now, what happens as you increase the debt, leverage debt equity ratio? What you are doing? You are increasing the leverage. You are increasing the debt. He says, as you keep on increasing the debt, what will happen? The expectation of the equity shareholders increase, that we just discussed. Why? Equity shareholder says that we are the risk bearers. As you keep on adding the debt, you are adding the risk also, because debt is a riskier instrument, right? Cheaper instrument, agreed, sir, but it is a riskier instrument. So, and who will bear the risk? The equity shareholders will be bearing the risk. So equity shareholders say, because you are increasing the debt, it is increasing our risk, right? So our expectations will increase, and the expectations are represented by KE, right? So this is what? This is the expectations of equity shareholders will increase. Expectations of equity shareholders will increase with increase in debt, right? So the expectations of the equity shareholders will increase with the increase in debt. Now what will happen, sir? On one hand, you are introducing a cheaper source of finance, that is KD. On the other hand, the KE is going up. The ultimate result will be that the overall cost of capital remains constant, right? The overall cost of capital will fall if you keep on increasing the KD, because that is what? That is a cheaper source of finance. But on the other hand, the expectation of the equity shareholders are increasing, resulting in KO, that is overall cost of capital will remain constant, right, sir? So this was the second approach, that is the net operating income approach, that KD and KO remain constant at all levels of the leverage. The KE rises with the increase in leverage as the expectations of the equity shareholders increases. Every capital structure is the optimal capital structure as KO and the value of firm remain constant at all the levels, right? KO and value of firm remains constant at all the levels. If the overall cost of capital is constant, the value of firm will also remain constant, sir, right? The next one is the traditional approach. The traditional approach says the KD and KE. Okay, what is traditional approach? He says as you keep on increasing the debt, yeah, right, your KD will increase. Your KD will increase, and with the introduction of the debt, the expectations of the equity shareholders will also increase. But he says that increase will be initially very slow, right? This will slowly increase. Initially, the expectation of the shareholders will increase slowly, resulting in the fall of the overall cost of capital. Why there is a fall in the overall cost of capital? Because debt is a cheaper source of finance. But as you keep on adding the debt, more and more and more and more of debt, your KD will also increase. The KE will increase at a sharper rate, and the overall cost of capital will also increase at a sharp rate. So this is what is the traditional approach says, that as you increase the debt, the KD will increase slowly, KE also will increase slowly, resulting in the fall of the KO, that is the overall cost of capital, because debt is a cheaper source of finance. But as you keep on increasing the debt, you keep on increasing the risk, right? The expectation of the equity shareholders will increase, and that will increase sharply, that is KE, resulting in the sharp increase in the KO. Clear? So this is traditional approach. Now comes the two very important approaches, that is the Modigliani-Miller theory, that is the MM approach. Very important approach, sir. The MM approach. There were two theories that were given by MM1 that was given in 1958, and it ignored taxation. That theory, the assumption of that theory was there is no taxation, whereas in MM2 given in 1963, it says with taxation. With taxation. Right, sir? Now, what was the basic of this MM theory? Let's try to understand. MM theory. What is the basic of this? The MM theory says the firms that are existent in the market can be divided into two parts. These firms can be divided into two parts. One is a levered firm. One is a levered firm and another one is the unlevered firm. Another one is unlevered firm. Right? So there are two, basically there are two firms, levered and unlevered. What is an unlevered firm? The unlevered firm is the one which is having only equity in the capital structure. Which is having only equity in the capital structure, and the levered firm is the one having debt plus equity, both having debt also and having the equity also in the capital structure. So he says the firms can be divided into two parts. One is a levered firm and another one is the unlevered firm having only equity, right? So in this case, in case of unlevered firm, what is the KE? KE of the unlevered firm, we call it as KEU. Let's say it is 25%, right? What will be the overall cost of capital in this case? Sir, the overall cost of capital will also be 25% because there is only one capital, that is equity. Whatever will be the cost of equity will be the overall cost of capital of the firm. Any doubts in this thing? Yes, sir. But in case of the levered firm, let's say debt is 10%. So the equity, the expectation of the equity shareholders here will be more than 25%. He says, sir, 25% I am already getting in another firm where there is no debt, there is no risk. Here, there is a risk of 10%. There is a risk because the debt is there. So please, I want more than 25%. So here, the cost of equity will be more than equal to 25%. They can ask for equal to 25% also, but they will be asking for more than 25% because the shareholder will say that's a 25% I am getting in a firm which is having no risk, right? That is all equity firm. So here, because the risk is there, I will be bearing the risk. I want more return on this. Right? So in this case, this is your KD, sir, 10%. How the KE of the levered firm is calculated? As per the MM approach, how the KE of the levered firm is calculated, we call it as KEL, right? That will be whatever the KE that he will be getting in the unlevered firm, plus he wants something extra. What is that something extra? We call it as risk premium, right? Risk premium means some extra return for taking the risk, right? So what is that some extra return that he wants? What is the risk premium here? Plus, he says, what is KEU minus KD? This is the extra return that he wants in the proportion of debt divided by equity. As you keep on increasing the debt in relation to equity, your risk premium will also increase, right? So for example, in this case, this is 25 plus 25 minus 10 is KD, and whatever is the debt, let's say the debt equity ratio is 2 rupees debt, 1 rupee is your equity. If the debt is 0, there will be no risk premium, right? If the debt becomes double, your risk premium should also be doubled, right? So this becomes 15 multiplied by 2, right? So this is 25 plus 30 is equal to 55% return. He says you are increasing the double the debt, right? So the risk also gets doubled. So I want the double premium, sir, right? So this is how the KE will be calculated. Right? Now, in this case, again we say that in the case, this is MM theory without taxation. What we are discussing is MM theory without discussion, and this theory says, again, if you keep on increasing the debt, the expectation of the equity shareholders will increase, right? That will lead to the KO remaining the constant. Come here. Let's see. The KEL, this we have discussed. Now we say that as you keep on increasing the debt, the expectation of the equity shareholders will increase, and in this case also the KO remains constant. This shows the expectation of equity shareholders. This is similar to net operating income. This is an extension of that approach only, right? The KD remains constant, KO remains constant, and KE increases. Right? Now, what will happen, sir? If KO remains constant, that means the value of firm also remains constant, sir. Let's see. The value of firm also remains constant. Value of debt is increasing, value of equity is falling. Why value of equity is falling, sir? Because cost of equity is increasing. If the cost increases, the value will fall down, right? So here no taxation. Now what will happen, sir? Overall cost of unlevered firm is equal to overall cost. The overall cost of both the firms will remain same, sir. Right? The overall cost of the unlevered firm will be equal to the overall cost of the unlevered firm. Value of the levered firm will be equal to the value of unlevered firm. Clear? That is why we say na that overall cost of capital will remain same whichever the firm you are going for, right? The overall cost of capital will remain same because you increase the debt, the expectations will increase. Overall cost of capital, there will be no change. And if the overall cost of capital is same, the value of firm also is going to be same. So this was MM theory without taxation. Now in 1963, there was another MM theory which was given, and that MM theory was given with taxation. Right? So what is MM theory with taxation? He says, now what will happen in case of taxation? Sir, in case of taxation on this debt, there will be tax savings on interest. Tax savings on interest, isn't it? Yes, sir. There will be tax savings on interest, and because of the tax savings on interest, what will happen here, sir? The overall cost of capital of the levered firm will be less than the overall cost of capital of the unlevered firm, right? Because this levered firm will be saving something in the form of tax savings on interest on debt. So overall cost of capital of the levered firm will be less than the overall cost of capital of the unlevered firm. And what is the result of that, sir? The result is that value of the levered firm will be more than the value of unlevered firm. Why? Why, sir? Because the overall cost of capital is less of the levered firm, the value will be high. High by what? The high by the tax premium only. So KO of the levered firm will be less than KO of the unlevered firm. Value of the levered firm will be more than the value of unlevered firm. And what will be the value of the levered firm? That will be value of unlevered firm plus the tax savings. This is what? This is tax savings on interest. That is calculated as debt. What is the value of debt multiplied by tax? Right? Sir, you are saying the tax savings is on interest, and here you are saying on the value of debt multiplied by tax. Right? How is it possible? Sir, he says, what is this value of debt? You are paying interest here, you are going to pay interest here, you are going to pay interest here, you are going to pay interest here. Right? This is all what? This is all your interest. Now, if I ask you to calculate, now this you will be paying up till infinity. If I ask you to calculate the present value of this interest, if I ask you to calculate the present value of this interest, that will be equal to the what? That will be equal to the value of dividend here, sir. That will be equal to the value of dividend here. Already in the chapter of capital structure, we studied about it, that if the cash flows are till infinity, till perpetuity, right? How to calculate the present value? The present value is whatever the interest divided by the rate of discounting, and this present value of all this will be equal to present value of interest will be equal to the value of dividend. right? This will happen only if the interest amount is equal and it is still perpetuity, right? So on this, you will be having the tax savings, sir. You will be having the tax savings, right? So that is why it is the value of debt into tax savings. These amount of debt by the debt employed by the levered firm into tax rate, right? So KE of the levered firm here will be, here you have to take only the tax benefit into consideration, d divided by into 1 minus tax. The tax benefit you will be taking into consideration. Now value of firm EBIT divided by KO, but if there is a tax benefit, that EBIT into 1 minus tax divided by KO. Clear? In this case, the KO, there will be a change in the KO. The KO will not remain constant, sir. The KO will fall little bit. KO will fall little bit in case of the levered firm. In case you increase the debt, that is the levered firm, you increase the debt, your KO will fall down, right? So this is what is MM theory. Now, under the MM theory, these were all the theories that we have discussed. Now, under the MM theory, there is another one very important topic, that is arbitrage process. Now, what is this arbitrage process, sir? Arbitrage process says that I am the shareholder. I am holding a certain percentage of shares in a company, whether it is a levered company or unlevered company. I am holding a certain percentage of shares in the company. Now, I want to switch to another company, and with the shareholding, I want to earn the benefit of switching. Why? Why will I earn the benefit of switching? Due to the difference in the values of the firm, right? Due to the difference in the values of the firm, I want to sell my shares in one company and I want to invest in another company, and I want to still gain from that. I want to still gain from that. That is what is known as arbitrage process. Let's see how this arbitrage process takes place. I'll explain with the help of an example. Arbitrage process, right? Arbitrage process. With the help of an example, plus I will give you the step-by-step solution, right? I'll give you how you have to solve this arbitrage process question, how you have to solve it, sir, right? Let's say there are two firms. One is a levered firm. One is a levered firm and another one is the unlevered firm. Unlevered firm. Right, sir? Certain basic information is given to you. For example, he says the EBIT is given to you. The EBIT remains constant at all levels. This is the assumption of the theories, right? So EBIT, let's say, is 2 lakh rupees, right? And here also it is 2 lakh rupees. Now, I'm saying I will pay interest on debt. Interest on debt. Let's say it is 10% and the debt value is 5 lakh rupees. Right? So I will pay 50,000 interest on the debt, and it will be only in case of levered firm, not in case of unlevered firm, sir. Only in case of levered firm I will be paying interest, nothing here, sir. So what is there? This is EBT. And this arbitrage process is taking place under the MM theory without taxation. That is, there is no taxes. So this EBT becomes my earnings after taxes, and this becomes my residual earnings, right? 1,50,000 and here it is 2 lakh. Now let's say the KE is given to you. What is given to you, sir? KE is given to you as 13% and 12.5%. Right? This is KE given to you. Can you tell me what will be the value of equity? I just told you that value of equity is residual earnings divided by KE. Right? So this value of equity is coming out to 11,53,846, and in this case it is coming out to be 16 lakh. What is the value of debt? Debt value will be only in case of levered firm, that is 5 lakh rupees. Right, sir? How do you got to know? From here, sir. 5 lakh value of debt. Right? Here there is no value of debt. So this will give you the value of firm. Right? How much, sir? 16 lakh 53,846 and 16 lakh is the value here. Right? From here, can you calculate KO? What will be the KO, sir? KO will be EBIT divided by value of firm, that will come to 12.09%, and this will be 12.5%. Right now, what there is a person, let's say Mr. X. Mr. X holds 10% shareholding in 10% shareholding in levered firm. Now, what is he trying to do, sir? What is he trying to do in the levered firm? Now, Mr. X, what he wants to do is, Mr. X, wait a minute. Mr. X wants to shift his shareholding from levered firm to unlevered firm and take benefit of arbitrage process, and he wants to take the benefit of arbitrage process, right? Sir, how? See, the value of firm, he will move from a high value firm to the low value firm, right? He will sell the shares, he will be getting the high value for the shares from the high value firm, and he will be investing in the low value firm, right? After that, what will happen, sir? He will be left with some money. Let's see what are the steps involved in the arbitrage process. So this is the basic question related to the arbitrage process, and I say Mr. X is holding 10% shareholding in the levered firm. Now he wants to shift his shareholding from levered firm to unlevered firm and take the benefit of arbitrage process. How will he take the benefit? Let's see. Solution. What is going to be the first step? Sir, the first step is Mr. X sell his shareholding in levered firm, right? So what is the amount if he is going to sell his shares? What is the amount that he will be getting? That is 10%. 10% of what, sir? 10% of the value of the equity. 10% of that he will get, sir. This is the value of total value of the equity of the firm. And if Mr. X is holding 10%, he will get the 10% value of this, right? If he sell the shares, 10% of 11,53,846. That means he will get, sir, 1,15,384 rupees, right? Now, second step. What is the second step, sir? Second step is Mr. X wants 10%. He will have the same shareholding. He wants 10% shareholding only, right? Mr. X wants 10% shareholding in unlevered firm. So what is the amount that is required, sir? What is the amount that is required? That is, he wants 10% of 16 lakh. He wants 10% of 16 lakh, that is 1,60,000 rupees. Now, if he wants to buy the shares of the unlevered firm, he will need 1,60,000. But currently, how much amount he is having in the pocket? He is having only 1,15,384 rupees. Right? He is having only this much of amount. Now, how will he arrange the other funds? Now, step 3. Mr. X will take a loan from bank. So how much of the loan that he will be taking? He says the loan will be equal to what is the debt equity ratio. The loan that Mr. X will take will be such a loan so that whatever is the debt equity ratio which was maintained in the firm, the same debt equity ratio is maintained here. Can you tell me what is the debt equity ratio here? What is the debt equity ratio here, sir, in this firm? What is the debt? 5 lakh. And what is the value of equity? That is 11,53,846. So that is 0.4333:1. Now the Mr. X will take the loan in the same ratio, right? So that means this is the assumption of this theory, and this is the assumption of this arbitrage process, right? So if for one equity share, What is the loan amount? That is 0.433. Now for every one equity share, now he is having how much of the amount of equity shares? For 1,15,000, 1,15,384. How much is the debt he can take, sir? How much is the debt that he can take here, sir? Calculate it. How much is the debt that he can take? The debt amount here will be rupees 50,000. At what rate? 10%. Another assumption, the assumption of this theory says that personal interest rate is equal to corporate interest rate, right? So the corporate is paying the interest rate at the rate of 10%. So the personal, if he is taking the loan in the personal capacity, that will also be at 10%, sir, right? Now, fourth step. What is the fourth step here? Now, what is the total amount available? Total amount available with Mr. X. Available with Mr. X. What is that amount, sir? 1,15,384 plus 50,000 he has taken a loan. So total amount that is available with is 1,65,384. This is the total amount now available with Mr. X. How much he will be investing minus out of this, what will be the investment that he will be making? 1,60,000. So this 5,384, what is this is known as the excess amount that will be available. This is what is known as arbitrage gain that he will be having, sir. Arbitrage gain. This is the arbitrage gain that he will be having, that even after investing 1,60,000, he is left with 5,384 in his pocket. He can do anything with this money, right? Let's see what is the impact on the earnings. Fifth step, impact on the earnings of Mr. X. Impact on earnings of Mr. X. Sir, will there be any impact on the earnings of Mr. X? Let's say, what was he earning under the levered firm? Under the levered firm, what was his earnings? That is 10% shareholding out of what? 10% of what, sir? 10% of this residual earnings. He must be getting 10% out of it, sir. So 10% of 1,50,000. Right? That is, he was earning rupees 15,000 under the unlevered firm. Now what happens under the levered firm? He was earning 15,000. Now what will happen under the unlevered firm, sir? He will still earn 10% because he is having the same shareholding, that is 10%. So he will earn 10% of what? Sorry, this is 1,50,000. Now he will earn 10% of 2 lakh rupees. That is 20,000. Now you will say that, sir, the earnings have increased. No, wait a minute. Sir, if he is earning 10% of 2 lakh, that is 20,000 rupees. Here, he will have to pay interest also on debt because he has taken the debt in his personal capacity. That is 10% on 50,000. Right? So 5,000, he will be paying interest. So the ultimate earnings that he will be having under the levered firm and the unlevered firm, that will remain absolutely same, right? That will remain absolutely same, sir. So these are the steps, and this 5384, this is known as arbitrage gain, that even after investing 1,60,000, he is left with 5,384 rupees in his pocket, right? Without impacting the earnings of Mr. X. This is important, sir. This is important. Debt equity ratio is to be maintained. Debt equity ratio is to be maintained. Clear, sir? Now, there is one more scenario here. In this case, we say that Mr. X wants 10% of the shareholding only, right? So what he is doing is, if he is having 1,65,384, he is investing only equivalent to the 10%. That is, he is investing 1,60,000. There can be another scenario when he is not concerned with holding 10%. What is he doing is, let's take another scenario where the amount available, what is the amount available with Mr. X? Amount available is 1,65,384. Now Mr. X says that I will invest the whole of this amount in the unlevered firm. What is amount invested? Now amount invested is not 1,60,000. He says whatever is available in my pocket, I will invest in the firm. Right? So here, what is the excess money? Sir, that means in this case, there will be no arbitrage gain. There will be. Sir, but the excess money is zero. How can you say that still there will be an arbitrage gain? See here. Earnings. Let's see now what will be the earnings under this. What will be the earnings under this? Now I'll give you another way of calculating the earnings. Listen to it very carefully. Right, under the leverage firm, right? Now, what is the earnings under the leverage firm? The earnings, can I say the earnings is 13% on this value? What is KE? The KE is the earnings of the equity shareholders. What is KE? The KE is the expectation of the equity shareholders, right? The KE represents the earnings of the equity shareholders. So I can calculate 13% of 11,53,846. I can calculate it this way. Yes, sir. I can calculate it this way, right? So under levered firm, it is going to be 13% of what? 13% of 13% of his share. 13% of 1,15,384. Sir, not 11 lakh. No, sir. X share is how much? X share is how much, sir? That is the value. This is value of X share. Value of X share. Right. So this will come to 15,000, sir. Now, what will happen under the unlevered firm? What will happen under the unlevered firm? Under the unlevered firm, the return will be 12.5%. multiplied by what is the value of the shares in the unlevered firm? Sir, this is what he has invested in the unlevered firm. 1,65,384. Right? This is what he has invested. So his earnings here will be 20,673 minus he will pay interest 10% on 50,000 rupees. He will pay 5,000 interest. So what is his earnings? 15,673. Right? So what is here? You will have excess earnings. Here you will have what? Here you will have excess earnings of 673 rupees. If not the excess money here, if he is investing more than his shareholding, then he will have the benefit in terms of earnings. Right? He will have excess of earnings here. Under the levered firm, he was earning 15,000. Under the unlevered firm, he will be earning 15,673 rupees. Right? So he's having the excess earnings. This is how you can calculate the earnings, sir. Right? The KE multiplied by the value of that share. That also represents the expectation, and that also represents this earnings of the equity shareholders. Right? So whole of this is what? This is another arbitrage process. Right? I have given you the possible scenarios that how you can calculate the arbitrage process. I have given you the step-by-step calculations of the arbitrage process, that how this arbitrage process takes place. Right? Now, another important area that is there in the capital structure is the financial break-even point. Let's quickly talk about two small topics. With this, we are ending the capital structure, sir. Two small topics is financial break-even point. Financial break-even point. Right? What is this financial break-even point? The financial break-even point is the earnings which are required to pay off your fixed financial cost. Right? It is the level of EBIT, which is just sufficient, to pay off fixed financial cost. What are the fixed financial costs, sir? what are the fixed financial costs? If you talk about the fixed financial cost, what are the fixed financial cost? That is, the fixed financial cost is interest on debt and the preference dividend. Interest on debt and the preference dividend. For example, let's take an example. If the interest on debt is, let's say, 10,000 rupees. So what is your financial break-even point? Your financial break-even point will be 10,000 rupees, sir. Any doubts in this thing? Your financial break-even point will be 10,000. I'll take another example now. I say preference dividend to be paid is 10,000. Tax rate is 50%. Now, tell me what will be the financial break-even point? What will be the financial break-even point? Will it be 10,000? Will it be 10,000, sir? Will it be 10,000? No, sir. Preference dividend is paid after paying off the taxes. So that means you will have to earn more than what is the preference dividend to be paid, so that after paying off the taxes, you are left with 10,000. After paying off the taxes, you are left with, see, what is EBIT here? EBIT, I say, I don't know what is EBIT here. What is interest here? Forget about it. Let's say it is 0, right? That is EBT. EBT minus taxes will give you what? EAT. EAT minus preference dividend will give you what? That will give you, this is what we know, right? So, preference dividend you want to pay is 10,000. So what should be your earnings after taxes? That should be 10,000. Now, if the tax rate is 50%, that means you are paying a tax of 10,000, sir. Right? What is your EBT? EBT is 20,000. Right? So what will be your EBIT? EBIT will be 20,000. So what will be the financial break-even point in this case? The financial break-even point in this case will be preference dividend divided by 1 minus tax rate. Right? So 10,000 divided by 1 minus 0.50, that comes to 20,000, right? So this is how the preference dividend will, financial break-even point will be calculated, right? This is how the financial break-even point will be calculated, sir. This is regarding the financial break-even point. Now, one last topic is indifference point. One last topic is, sir, that is indifference point. Right? Indifference point. What is indifference point? He says that in a capital structure, let's say you have two options. One is equity option, that is only equity option, and one is debt plus equity option. Under both the options, the EPS is same. Let's say EPS is 5. Here also the EPS is 5. Now you are indifferent between the two options. In case of indifference point, you are required to calculate that level of EBIT. You are required to calculate that level of EBIT where you will be indifferent between this equity and debt plus equity option. Right? So you need to find out the level of EBIT, the level of earnings where you will be indifferent between these two things, right? So you will calculate what? You will calculate the EPS. How to calculate EPS under this option of equity? How will you calculate it, sir? EBIT, right? On EBIT, will you pay any interest? No, sir. There is no interest. You will simply pay taxes. And if there is preference dividend, you will pay the preference dividend also. That is residual earnings divided by number of equity shares. Number of equity shares, right? And in this case, it will be EBIT. First, you will pay interest on EBIT. From that, you will pay taxes minus, if there is preference dividend, divided by number of equity shares, right? Everything will be given to you except for what? Except for this EBIT. Everything will be given. You have to equate this and you have to calculate what will be the value of EBIT where you will be indifferent between the two options. Right? So you have to calculate the value of EBIT where you will be indifferent between the two options. This is what is indifference point in the simple terms. Right? So in simple terms, this is what is the indifference point. So with this, I've covered all the important aspects of the capital structure according to the practical point of view, according to the conceptual point of view. Now, what you have to do is, it's your responsibility now to practice the questions from the ICAI module, right? More than sufficient. Very good questions you have in the ICAI module. Almost every type of a question is covered in there. Right, so we are done with the capital structure and we are left with one major topic, that is dividend decision. Then risk analysis is a very small topic, right? One major topic is dividend decisions that we are left with after this, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.